Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to master the game of building wealth. And before we get into today's episode, I just wanted to let you know that on the 28th of May at 7 p.m, I am going to be speaking with Jared McCabe live on YouTube. And the topic is the top 5 mistakes that cost millions of dollars in terms of what mistakes do people make that we've seen over the last few decades that results in buying a substandard property. And look, some of these things are quite obvious. A couple will be kind of obvious, but there's going to be a couple there that I think trip up a lot of investors. So if you're interested in that, the link is in the show notes for you to register for that event. And we'll then, leading up to the event, send you all the links and so forth, and you can join us on the 28th of May after work at 7 p.m. Okay, let's get into today's questions then. And my first question is from Jack. Jack writes, I've had a number of discussions with the broker on the pros and cons of offset versus redraw. I'm heading for retirement soon and want to have as much flexibility as possible. One broker is saying there's a free unlimited redraw account with salary deposits and redraw to pay for expenses via a credit card that has 55 days interest free. It claims that it's a much better than an offset account. It will save you a lot more than an offset account. I think my CBA account has both facilities with my offset account and redraw. Sorry, I probably should have pre-read it because it's not worded perfectly. Sorry, Jack. Anyway, it's a really great question because, just thinking like nearly 25 years ago, 23, 24 years ago, there was a lot of misinformation about offset accounts and how much they would save you. And I remember one of the very first articles I ever wrote was about this topic. Anyway, it won't mean much to most people listening because, unfortunately, probably a lot of people couldn't even say the word offset 23, 25 years ago. Anyway, for those old enough to remember, they were relatively new products back then. And there was a lot of claims. The thing is that you've got to be aware of is that the banking industry is pretty archaic, and so is a lot of their systems. So when they come up with a policy or a product, quite often their policy and product is confined by the ability of their system. And in fact, CBA about 10 years ago, they said, and I won't get these numbers perfectly correct, but they said that something like they use 27 different systems to write a mortgage, to set up a new loan. So they might have one for a different system for the security, a different system for, doing the serviceability, another one for the actual banking system. And they had to re-enter data many times into these different systems. Anyway, they spent a lot of money and they've got it down to just a handful of systems now, as I understand it. And that for a long time, CBA never had a true offset account. They would offset the interest earned rather than the balances. And of course, you don't earn much interest on transactional accounts. So when you see these sorts of claims and these sorts of idiosyncrasies between lenders and someone's sort of saying, oh, but this has got free salary deposits and then you can use a credit card. The answer is, no, I'm going to take a guess. It's Heritage Building Society, just from my knowledge in terms of the lender that Jack's talking or referring to, or maybe what the broker's referring to. And the answer is that it's nonsense, that most of these things are a result of technology limitations. And again, if a bank says to you, oh no, we can't take a company share title as security, or we can't do a loan in a company's name, these sorts of things, quite often it's not because they don't want to or that they perceive it as risky. It's just they just can't, their systems can't get around it. Now let's talk about offsets and redraw. For home loans, no big deal. Non-tax deductible loans doesn't really matter. Put it into the loan, put it into the offset. Neither here nor there, they're both going to achieve the same financial outcome. Of course, putting money into a home loan psychologically is a little bit better because it means you actually have to redraw to go and spend those savings. Whereas if they're just sitting in the offset account, sometimes for some people can be too easy to spend. But with respect to investment loans, never use redraw. Always use an offset. And the reason for that is that you get to preserve the original tax characteristics of that loan. So you don't alter that. Whereas if you redraw, so if you repay a loan from a purpose perspective, you have repaid that purpose. And so then if you redraw, it depends on what you use those redraw monies for, is whether they're going to be tax deductible firstly, and then secondly, what asset they particularly relate to. So, if I had an investment property, $100,000 mortgage against that property, I repaid 20 grand. And then I thought, okay, I'm going to do some renos to that investment property. I redrew $20,000 and paid for the renovations. Not that big a deal because it's all tax deductible, all relates to one asset. Whereas if I decided to redraw 20,000 and go on a holiday, that's terrible because I'm mixing non-deductible and deductible purposes. If I redraw 20,000, decide to put it in the share market, again, that's not ideal because I'm mixing those purposes. And remember, the ATO says I can apportion interest and I can do that calculation. It's messy, but I can do it. But the thing is, if I go to repay a loan, I have to repay each purpose proportionally when I have a loan that has mixed uses, and that's not ideal. So always separate loans by asset and by deductibility, and be very careful about using redraw. Just put money in offset account, particularly as people heading into retirement, because there's nothing better than increasing liquidity going into retirement. So I'd rather have a whole bunch of cash in offset accounts because that really increases my liquid assets. And so, for example, if the share market has a really volatile period of time, I might say, well, I'm going to draw absolute minimum from the share market and dip into my offset account. At least I've got that flexibility. Whereas if you put it into the loan, you're going to have to redraw. It's going to be non-tax deductible and so on. So really long-winded answer to Jack's question there, but I just wanted to give you a little bit of sort of insight and share the many, many, many years of experience that I have. No wonder I feel so tired. Okay, next question is from George. Really succinct question too, George. Well done on that in terms of giving me all his information. So George is 58, his wife is 51. George's super balance is about 620, his wife is 120. George earns 180,000 a year, his wife does not work. They have rental income because they've got no debt. Rental income of 75,000 less about 25,000 for expenses, about 50 grand left over. The home is, so everything's owned outright, no debt, as I said. The home's worth $2 million. They've got a investment property that's 9910, mostly in George's name, worth $1.5 million. And then George and his three brothers own three $1 million townhouses. So let's just call it $1 million in George's name. So really $2.5 million in property and about 740 in super. And they just sold an investment property and will net about 260,000 after capital gains tax. And George is asking me what to do with this $260,000. He's mentioned a couple of examples like non-concessional contribution to super, go and buy another investment property, invest in shares, maybe split it across shares and super. And he wants to retire in 4 years' time. As I said, he's 58, so pretty close to being able to access super, although his wife's a bit younger than he is. So it's a pretty easy one there, George, because, I would argue you've already got enough money invested in property, 2.5 million in investment properties, plus your home, another two. So you've got 4.5 million of your overall wealth in property. I think that's probably enough. Also, you want to start thinking about tax effectiveness. And so if you start investing in personal names, look, it might be tax effective. Remember, if you earn up to $45,000 a year when you're retired, that is, have no other income, you're only going to pay about, I worked out about 15-ish%, 15, 17% average tax rate, which is still pretty low. It's not going to be the end of the world, but you're going to pay some tax. Whereas inside super, you're not going to pay any tax. Also, your wife's balance is relatively low compared to yours. So it's a no-brainer for me, George. I would put that $270,000 into your wife's super account just to try and even up those balances a little bit. That'll take hers to 380. Yours is 620, so still a lot more than hers, but at least we're sort of balancing it up a bit. I would imagine that you'll continue to you'll start to draw on super when you retire in 4-ish or so years. Your balances will appreciate hopefully between now and then. And it might help you fund kind of the first 10-ish plus years of retirement. But I imagine in your strategy, you're going to have to sell another property at some point, maybe one of the townhouses that you own with your brothers, or potentially the other investment property that you have. And then the goal would be to try and get that into super as well. So definitely inside super. You talk about volatility and timing and all those sorts of things. Maybe I should do an episode really on, because that's on people's minds at the moment, particularly with all the uncertainty in the US. Look, I'm not too concerned about it, because what I'm really thinking and what I'm encouraging, or I would encourage all listeners to think about that are in George's position, is that, George is worried, well, what if I invest the money today and it gives me negative returns over the next 6 months? But really what we need to be thinking about is, what can we do today? What can George do today at 58 years old with his $260,000, so that when he's 68 years old, he looks back and goes, that was a good decision. That worked out well for me. Definitely get it inside super. And I think just remain fully invested in the share market. Sure, there might be some volatility, but if you have a look at all the evidence, and remember, this is an evidence-based podcast, all the evidence shows that over the longer term, you'll be better off. And, I don't think we should get dragged down too much by Trump's rhetoric. He has demonstrated multiple times over the last couple of months that he's willing to chop and change. Unlike a lot of leaders that might be a bit dogmatic in their views, you couldn't accuse Trump of doing that. He's liable to just do a complete U-turn tomorrow, and it wouldn't surprise anyone. So, and I think that's what the market is really factoring in, by the way. I mean, the market sort of hasn't fully recovered. It's still down about 4-ish% today to the US market. But, I think what the market's saying is we disbelieve that these tariffs are going to be around for a long period of time. So anyway, thanks very much, George. I hope that's been useful. Okay, next question is from Shan. And Shan writes, my wife and I have been listening to your podcast for a while. It's been super helpful for us to build our own financial literacy, as each episode teaches us something new. I've recently mentioned the prospect of making 3 episodes a week. Please, please, please make it happen. What a lovely thing for you and your wife to do together. I think that's amazing. This is a safe space for me, because I am certain my wife doesn't listen to this podcast. She does read all my blogs. So she reads it, I guess, in text format. Not pleasingly, I should say, or not willingly. I force her to do that. But what a lovely romantic thing to do with your partner, is listen to this podcast. 3 episodes a week. Well, it got to a point where I was receiving so many questions, I thought maybe I got to do 3 per week. But I also, I don't want to bore people to death. So I reckon 2 per week's fine. Although I still do get quite a lot of questions, which is great, by the way. Keep them coming in. Okay, let me get on with it, because Sean says, my question is around the timing of dialing up super contributions in one's working life. My wife and I are both in our 30s, working as PAYG employees, making around $110,000 a year. We have 2 toddlers, our own home with a mortgage. We also have 2 investment properties that are offset to the extent that they are cash flow neutral. You frequently mention that super is tax-effective environment to build wealth in and compound over time. However, you also mention that with young people in their 20s and 30s, directing surplus cash flow into super may not be the best way to build their wealth, as money is going to be locked away for a long period of time. Because I guess that's a double-edged sword. For someone similar to our profile, how do you decide the best time to start increasing super contributions? What are the questions you would need to ask ourselves before deciding to dial up our super contributions? Sean, that's an awesome question. It's a really great question. Look, I think I would kind of answer that by working backwards. And what I mean by that is that, let's choose 60 as a retirement age, just because you can access super at age 60. And it seems like a good enough number to kind of work with. We don't necessarily want a perfect asset allocation by age 60, so the day we start retirement, because in fact, our strategy might include selling assets after retirement and, for example, property and so forth, to minimize capital gains tax. So it might not be a perfect sort of point to kind of aim for. So let's say if we retire 60, let's say 65. Let's say 65, by age 65, I want a really good asset allocation, and I want my asset base to be as tax effective as possible. which I think is a good goal, right? And that would be the goal that I would have in my own mind for a client that I'm working with. Okay, so I would then be thinking about by age 65, how much wealth do I think I'm going to accumulate? So again, this is sort of falls out of financial projections, but at a family level in terms of investment assets, so that is everything excluding the home and any holiday houses, any personal use assets. If I have more than $4 million, then I'm going to be okay with having some money outside super. But if I project I'm going to have up to $4 million of investment assets, then really my goal is how am I going to get all that money into super? And that's what I then need to then think about and kind of work backwards because it depends on the assets that I have, my cash flow, the distribution of surplus cash flow over that sort of period of time. But to my mind, every person can have $2 million inside super that's tax free. And so I don't mind having a little bit of assets outside of super because, as I said in the last question, I can earn up to, let's say, 20,000, I'm not going to pay any tax, 30,000, I'll pay very little. So I can maybe have $30,000 of income, taxable income in my personal name, and maybe each spouse, so 60,000 at a family level. I'm not going to pay too much tax. I can live with that. So I can live with having some investment assets in my personal name, but the bulk of it I want inside super because it's no tax, of course. So that's what I need to then build a plan around. And that's what we would be thinking about when we work with clients. The other thing we've got to overlay, the other thing that's going to pull it in the other direction and create some tension is that we don't necessarily want to put all our eggs in one basket, not necessarily leading into retirement as accumulators, because we want to spread our eggs amongst different baskets. We always want to take advantage of negative gearing and these sorts of things in personal names while we're in our working life. And the other thing too is what I want to do is provide flexibility. So what happens if we get to mid-50s and go, you know what? I want to go down to 3 days a week. And if you've been investing and sacrificing over the previous 20 years to get yourself in a financial position where that's possible, then to my mind, we should make sure that it's realistic and that you can do it. So therefore, locking all your money inside super doesn't really get you there either. It's not really a good answer, Sean, to your question, because I guess what I'm saying is it depends, which is probably the most unhelpful answer to any question. The other thing I would think about, particularly if you're younger, so in your situation, which I think maybe it's worth me sort of rounding it back into your situation. So in your situation, you've got I think your own home, without a mortgage. Okay, so you got no non-tax deductible debt. That would be my first question in terms of whether I should make additional super contributions. Because if you had a non-tax deductible debt, so a home loan, of course, that would probably be my priority. Not necessarily down to zero, but I want it to get it to a really manageable level. You also said you've got 2 investment properties that are neutrally geared. So that's good. That's working for you. In your mid-30s, the question then, I think in your situation is, given you are in a really good position from a income and asset perspective, from what you've told me, the question I would be contemplating in your situation is, do I now focus on super or do I buy another investment property? And if you're mid-30s, I think it really depends on your goals. If you like your job and you like what you do and you can see yourself working to 60, you'd be quite comfortable with that, I'd probably go and buy another investment property because I think in the long run, that's going to give you, a bit of flexibility because you've got the control of that asset outside super. And with the gearing, I think it's going to give you, it's a tax effective and mathematically with gearing a good way to build wealth. If you thought, no, look, we're going well and I'd like to have the flexibility to, reduce working hours in my 50s, for example, which is only like 15 years away for you, then I think I would start building a share portfolio outside super. So I wouldn't, and maybe I'd make some additional super contributions, but maybe I'd split it and start having a pool of assets outside super that I could fall back upon to allow me to wind back working hours some point in the future. And then the idea would be when you got, say, to 58 or 59, you would start moving some of that wealth into super. And so by the time you got to, say, age 65, again, most of your wealth is inside super. But it's a great question, Sean, and thank you for asking it and thank you for listening. And I hope you and your wife continue to enjoy the podcast. Okay, next question is from Pat. So just some context, Pat is married. He's 32 years old, long investment horizon. They have a 4-month-old baby, own their apartment that they live in, and have 2 investment properties in his name, one neutrally geared, one negatively geared. Pat's a cameraman that works under a proprietary limited company. Wife doesn't work while growing the family. And Pat said he set up a family trust a couple of years ago to hold, shares and property, but he only had about $20,000 in the family trust and thought there's no real benefit there. So he moved those assets into his personal name. But since then, his share portfolio has grown to 150,000 with 15% returns. That's fantastic. And dollar costing averaging into ETFs. And the question that Pat has for me is, what sort of portfolio size does a family trust, does it start to make sense to have a family trust? It's a great question, Pat. So thanks for writing in. I guess the first thing we need to think about, because a family trust gives us discretion around where we can distribute income. And that can be really useful if in a family unit, say we've got 2 spouses in a family unit, their income is going to be different from year to year. So for example, spouse 1 was the highest income earner this year, but spouse number 2 will be the highest income earner next year. So where there's a lot of variability in income from year to year within a family group, or if there's other people that we would like to distribute to, but those people could change over time. So for example, in Pat's situation, his wife doesn't work. So if we had a family trust, we'd probably be distributing all the income to her. But maybe in the future, Pat stops working, his wife goes back into the workforce. Well, then we can flip it around and distribute to Pat. So if that was to happen, a family trust can be useful. Pat's got a 4-month-old baby, which means we've got a dependent there. We can give $416 to that dependent in terms of investment income and not pay any tax. But that's not worth it, right? $416, big deal. But, when Pat's child is 18, we can distribute money to them, assuming they don't have any other taxable income, of course. If Pat's parents, if they're self-funded, so they're not relying on any Centrelink benefits, we could potentially distribute to them. So the first thing, Pat, and all the other Pats out there, that I'd be asking before I set up a family trust is, if I had a family trust, who would I distribute to? Who would I distribute to over the next 5 years? How would that change, say, 10 or 15 years from now? Because remember, we really do want to make a good long-term outcome. And what we want to do is ensure that if we set up a family trust and we pay for the cost to run that trust over the next 20 years, net, we want to be better off, of course. We realize that we might not be better off in the first 5 years. That's fine, but we could be wildly better off in 10 years' time from now. And we just need to make that long-term decision because we can't change in 10 years' time because of capital gains tax. So that's why you need to think about, well, if I did have that flexibility, do I have anyone to distribute to? So then if Pat said, no, my kids, he doesn't know yet, but my kids are going to be working at age 18, so that's no good. My wife doesn't plan to go back into the workforce. I don't plan to leave the workforce. And my parents are all getting the age pension, relying on Centrelink and so forth, Centrelink benefits. Then I would say to Pat, well, you know what, even if you had a family trust, I don't know it's really going to give you any benefit because we're always going to be distributing to your wife, in which case, why don't we just put the investments in your wife's name? So that's the first thing, is to think about potential beneficiaries. The other thing I haven't mentioned is, of course, we could distribute into a company. So we could have a corporate beneficiary, which I've spoken about before in this podcast. So that would be really useful for a couple, for instance, that were either already both on the highest tax rate and paying 47%, or expect to both be on the highest tax rate. That is something that at least we can then cap the tax at 30%, and we're not going to pay much more than that using a trust or an investment company, by the way, either or of those two things, depending on how we're funding that portfolio. So anyway, that's the first thing to think about. The next thing, which is really the question, is about portfolio size. Look, it's so different for everyone because I guess every family unit is different and our ability to distribute and minimize tax is different. But I like to really have about a 10-year time horizon. I'll probably take a little bit of a different approach for my personal situation, where I'm quite happy if the payoff's not in 10 years. I just want the payoff to be much better off in my lifetime. But when we're dealing with clients, of course, I don't want to make a recommendation, say, go and do this, and they've got to wait a long time to get that payoff. So I tend to sort of focus on a 10-year time period. And when I build a plan for a client, if I think the portfolio is going to be sort of north of $800,000 $1 million, $800,000 $1 million, then I would put that in a family trust. Even if that portfolio will take me a little bit of time to get there, the first few years, it's not that big a portfolio. But if it's really a key part of the strategy and we know that we're going to make contributions, it will get to that sort of $800,000 $1 million mark, that's when I'd put it in the family trust. If I thought, it was going to stagnate around a certain sort of level, of course, we hope it continues to appreciate, of course. But, if it was going to be materially less than that, then I probably would, in Pat's situation, I put it in the non-earning income spouse's name, or his wife's name, of course. So again, another very long-winded answer to an otherwise very simple question, but thanks very much, Pat, for writing in. Okay, next question is from Vanessa. Vanessa asks, I'm going to paraphrase the question. Vanessa said, I listened to your podcast that talked about, borrowing to invest in property and super, and the conclusion was that the tax benefits were very similar to investing in property outside of super. And the reason for that is whilst inside super, you might be able to avoid capital, or at least greatly minimize capital gains tax if you sell in pension phase. The downside was much less negative gearing benefit and higher interest rates. And those two things netted each other out. And so I did an episode a while ago about that, which I thought was kind of interesting analysis. But Vanessa's got a question about, well, what about if we have an ungeared property? So what about buying a property inside super using inherited funds? Would that be worthwhile, realizing that the properties are liquid, so that's a downside? But if we don't have any debt against it, at least we've got some capital growth and it will throw off some income. Or alternatively, would we be better off just investing in the share market? Well, Vanessa, it's a good question. My first question is, if you receive an inheritance, your first challenge is going to be getting the money inside super because of the non-concessional contribution caps. So we're limited in how much money we can put into super. If you have less than, I think it's about $1.7 million, this is when the carry forward non-concessional caps come back. So if you have less than 1.7, you can put in 3 years of non-concessional contributions. That's 120 a year. That's 360,000 in one hit. You could do that in July, and the previous year in June, you could put another 120. So you get 480 in there in one hit. And so if you have a spouse, you both might be able to do that. So you can get almost $1 million into super in one hit. But if your inheritance is much more than that, you're not going to be able to, most likely not going to be able to get that inside super. If you receive an inheritance, the only time you can avoid it coming out of the super system is if you are a beneficiary of that super and it's in pension phase and that's a reversionary pension, it can come into your name. Otherwise, if we're receiving inheritance, and even if some's coming from super, almost always that's got to come out of the super system, which is not ideal, but it is what it is. So if I had an inheritance of, let's say, $1 million, and me and my spouse thought we could put that money into super, would buying a property inside super be better? Well, if we're going to compare apples and apples and say, well, spend the $1 million on a property outside super versus inside super, absolutely. Super is going to be better because it's a concessionally taxed environment and zero tax in pension phase. So absolutely, it's a no-brainer. Of course you would do that. The question is, should you do that? Well, it depends on, the value of your super and what other assets are in the fund. But, one of the things that really works with property is gearing. That's the thing that really makes borrowing to invest in property work. And I did a podcast about this back in 2023, and it's before we started attaching the episode numbers to the podcast. So I can't tell you which episode it is, but it's in 20th of February, 2023. The blog is titled, It's All About Gearing, Not Property. So if you Google Pro Solution, All About Gearing, Not Property, it'll take you to that blog. And you can see there I've done some, what I thought was quite interesting analysis that demonstrates half of the return that property investors enjoy is a result of gearing rather than property. So Therefore, if we're comparing ungeared property versus ungeared shares, which is what Vanessa's talking about, well, then you've got to really then think about, okay, with property, what is my net return on an income basis? It might be 1 to 2%. What sort of capital growth will I get? Maybe 7% if we're going to be conservative. So you got an 8 to 9% return with liquidity, the potential to have maintenance costs and, maybe hassles with renters. It's not really a hassle. We can't overplay it, but, it's a little bit more of a hassle than, say, a share portfolio. Whereas with a share portfolio, I'm going to have a lot more diversification. It's going to be really low cost. I'm not going to have any hassles whatsoever. I'm not going to get a bill for a new hot water system or something like that. So I think if I was comparing, the ungeared investments, I'm not sure I'd go down the property route in that scenario, but really getting the money inside super is going to be the challenge. But look, a lot of great questions today, and thank you very much for submitting them. I really appreciate it. And if you've got any more questions, I'd love to hear from you. And until tomorrow, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.